Good morning. My name is Ariel Babcock. I'm FCLT Global's head of research. We are a not-for-profit organization supported by leading companies and investors worldwide that develops research and practical tools to drive long-term value creation for companies, savers, and communities. There's strong evidence that taking a long-term approach to investment decision-making delivers superior value over time, but managers and investors struggle to balance immediate financial pressures against long-term objectives many years into the future. FCLTCompass is our annual report that analyzes over 10 years of financial data to reveal important insights regarding the state of the worldwide capital markets. The research traces investor savings through various asset vehicles to the companies that deploy it in support of business and economic growth. We also attach investment time horizons to each segment across the value chain to compare the gaps in allocations and intentions. This webinar marks the launch of the 2021 iteration of FCLT's Compass, a report that's very focused on divergence. So in the midst of a global pandemic, there was not one unified approach or response to the effects of COVID-19. We saw savers reacting very differently around the world, but by and large, the investment time horizons of savers got shorter. On the other hand, companies moved in the opposite direction. Corporate investing in growth initiatives, doubling down on R&D and CapEx spending, even in the face of economic volatility, really contributed to a lengthening of average global corporate investment time horizons. We're going to talk about these findings today, and I'm very excited to have with me some of the leading economists from our member community to share their perspectives on the economics of resilience and to discuss how the pandemic has shaped investment and capital allocation behaviors in the markets they're watching most closely. So it's my great pleasure to introduce our wonderful panel. We're very pleased to be joined by Juhi Dhawan, Senior Managing Director and Global Macro Analyst at Wellington. Wellington is one of the largest private independent asset management firms worldwide and has a history of taking the long view. Bricklin Dwyer is Chief Economist and Head of MasterCard Economics Institute. The MasterCard Economics Institute is focused on analyzing macroeconomic landscapes through the lens of consumer in support of MasterCard's efforts to build a more inclusive and sustainable global economy. And finally, Prakash Khannan is Managing Director and Chief Economist at GIC. GIC is celebrating its 40-year anniversary and is a global long-term investor established to manage Singapore's foreign reserves invested in assets worldwide. So we're going to start off with a discussion amongst our panel and then move to incorporate some audience Q&A as well. So please submit your questions in the chat or to demi.mcclure@fcltglobal.org if you'd like to ask a question. So Prakash, let's start with you. So when we think about the saver community, retail investors and households, but also savers like pension funds or sovereign wealth funds, at the start of the pandemic, we saw a lot of savers understandably favoring safe haven investments. But as the time moved on, we saw some risk-taking behavior start to be introduced as they leaned towards renewed interest in equities. As a global long-term investor that's really active across all asset classes, how have you seen those trends play out? Do you really expect lasting changes in saver behavior post-pandemic?
Thanks, Ariel, and I guess a good morning to you, and good morning also actually to my fellow panelists. I think that the multiple aspects to that question, but the one interesting thing I think is that maybe similar to a lot of other areas, I think the pandemic has accelerated a lot of trends that actually existed pre-pandemic. Has really been, I guess, what you could call the democratization of finance. So I think what only used to be accessible to kind of certain groups of savers, like large institutional investors such as GIC, I think are now kind of increasingly being made available to retail investors. And I think importantly at a relatively low cost. And I think this trend is only likely to increase, especially with the tokenization of assets, I think being the next phase. So I think larger pools of savers will really have access to, things like real estate, etc., in a much more investable or cheaper form. So I think it's a structural trend. I think the danger, however, is that I think from that last point you made, which is this kind of renewed interest in equities from retail, I think a lot of these new investors have not really experienced a down market. And so, you've had some mini corrections, but have not really had a sell-off of more than 10% now for, I don't know, almost 20 months. And so while we can see that willingness to take risk, we don't really know the capacity to take risk. And I think that really hasn't been tested. And if the market does indeed turn, that may not be as high as some groups of people actually think. So that phenomenon, I think, is here for the long run, but I worry a bit about
risk-taking behavior is pretty interesting in terms of how it drives near-term asset turnover, but also how it influences asset prices over time. Maybe Julie, I'll turn to you next. We saw a really high degree of asset turnover in 2020. What do you think was contributing to that? Was it driven more by investors adding attractive assets at discounted prices, or some counter-cyclical behavior, maybe volatility-driven risk management to Prakesh's points? Any views on those risky behaviors in the markets?
I would say that the market structure has changed a lot in global marketplace today, and the speed at which markets can move allows investors to respond quite quickly to events as they occur. So the human pandemic has been really a very, very difficult situation for millions of people around the world. And of course, also because of its impact on the economy and spillover into every aspect that we all look at, resulted in tremendous volatility in asset prices at the start. That compressed but very sharp downturn led to opportunities. And investors this is our job, to look at the opportunities without, this is not taking away any of the human pain, but to look for those opportunities and make decisions based on that. But just as the drop was very, very large, so was the rebound. So the turnover in many ways comes from being trained to also, if something reaches the desired level at a certain point in time, you also move past it to look at other opportunities. So it's been a year in which the recovery has been uneven in the global economy, in which the long shadow of COVID has been very, very large, but also where the response from fiscal and monetary authorities has colored a lot of the investment decisions that people have made. I think all of those factors, given the new market structure in place, has seen some of that turnover that you talked about, Ariel.
Brooklyn, I saw you nodding there to what Julie was talking about. Did you have a view you wanted to add on that front?
No, I agree with Juhi on that. She said it well.
Well, then maybe we could turn to the opposite end of the spectrum now. Savers got a lot shorter term during the pandemic, but we actually saw companies move in the opposite direction. They took a really different approach on a global basis, kind of regardless of industry or geography. We were seeing companies really dramatically increase investments in R&D and fixed assets. I know you've taken a look recently at corporate investment in the digital transformation in particular. Are you viewing 2020, 2021 as a real turning point for companies kind of reinvesting capital back into the business? Is this the end of a fixed asset like business model, or is that investment in digital transformation really just the start of that trend?
Yeah, well, thank you very much. And hello to Juhi and Pritesh. I think that, what we saw before the pandemic was that, the investment was digital first, bricks later. And, that just got amplified dramatically during the crisis. And it pushed, folks who had a brick and mortar model into considering that digital. And even some of the older businesses that were well established and didn't think they'd ever go down that route. And so, we saw this transformation that was quite significant in that idea of investment. And that really, was across the spectrum. It pushed a lot of small businesses clearly into that sphere of being digital, but also large businesses, and trying to think about how they compete with those smaller businesses, the fintechs in the financial space, and just thinking about the business model to remain competitive. And that ultimately implied a fixed asset light business model that really challenged the status quo, that if you had a working model, you didn't need to make those changes. And I think that became very apparent. What was interesting is, as you look at this evolution, both businesses have been pushing that digital front from, really everything from the supply chain production side all the way to the delivery of goods. We've seen that digital evolution. And so you have businesses that are driving that. One, because demand is tremendous. If you think about, we estimate that about $1 in $5 is spent online in e-commerce, retail e-commerce today, versus about $1 in $7 in 2019. That's an aggressive shift. And if you think about what that means from the demand side, then it's, that's where people are shopping. That's where people are expecting the goods. They expect you to have that platform and that capability. And then on the supply side, it's just good business. And it's become this model of business insurance where, having that flexibility, having that nimbleness to be able to adapt to whatever environment we're in tomorrow. We think in this pandemic world today, but it may be we're thinking about a climate change world tomorrow, or something else that ends up requiring that resilience and requiring that digitalness. And I think it's worth noting that a lot of the big companies that have really done well, when you think about like rideshare programs, and you think about a lot of the media content, a lot of the media houses, aren't actually the content producers. A lot of the, the ride shares and things like that are not actual. They don't own any fixed assets. And so, that evolution of understanding how that opportunity is growing and how that, fixed asset light development, and that's where that exponential, that digital growth, if you want a business that grows digitally, you go light on the fixed asset side.
Ariel,
So
can I just add
Please.
something to what Brooklyn said? So I'm part of the central macro team at Wellington, and we think a lot about the medium term. So everything Brooklyn talked about is sort of a passionate part of my research. And what I would say has been phenomenal through this period has been a 50% rise in new business formation relative to the past. That's huge. And it is that necessity was the mother of invention, right? We saw the most distressed areas of the US economy being the ones who started going into these, the online platform, those who had not adopted it yet. But what has been great to see is we're sustaining it at those levels. So new ways of doing business and finding new ways of delivering efficiencies is what generates productivity in the long term. Forgive my nerdy economics hat, but that's what drives returns in the end, because that's what drives profitability, that's what drives growth, that's what gives benefit to more people over time. So we are very, very excited to see that this step up has been sustained for the last year and a half, because it's really going to make a difference for the economy in the long term.
Yeah,
So
just to piggyback on that, that new business creation, particularly in countries like the US and the UK, has just been outstanding and just so atypical of any other cycle. And the cloud computing, the cloud technology has really enabled that level of growth that's been tremendous. But it's not just that people are moving their existing ideas online. The evolution of those ideas are evolving too. And as you think about things like the subscription economy and these concepts of those reoccurring revenues, they really are built in that digital sphere of how do you capture that long-term trend and how do you grow that business in that way. So it's innovation, both in that new business creation, innovation in the delivery of that existing product that's evolving.
So I think, Julie, you're amongst economic nerd friends, so this is the place for all of that conversation. But I guess one question then to follow up on this here is, what we were expecting when we saw this reinvestment in CapEx that happened in the midst of the pandemic was that there was that we'd almost swung too far on the fixed asset light digital transformation. And perhaps this was a realization that there is some infrastructure required to support those businesses, and that owning that infrastructure yourself may be a more resilient long-term strategy. How do you see the intersection of those two tensions kind of playing out with corporate investment behavior going forward? And does it look different around the world?
I'm happy to take a crack at it. We all know there's been unprecedented fiscal stimulus in many parts of the world, and the US has been a leader in that. While the first part of that stimulus was really directed towards, just shoring up small business and shoring up distressed consumers, the plans that are now being discussed are all about infrastructure that has to do with physical infrastructure, infrastructure that has to do with climate change, infrastructure that has to do with green technologies and the future. And I really believe that the real bang for buck will come if we can go ahead with some of these plans. So I'm going to give you just one example, Ariel, of the kind of payback that we see when we look at studies that look at physical infrastructure. Physical infrastructure, and $1 spent in the United States has proven to show a return of $3.70 20 years out. Now I know 20 years out, again, this is our time frame, so I feel comfortable sharing that with you. But I think that's really phenomenal, and it has been proven to create jobs not just at the highest level, but at the blue collar level, which is an area which continues to be, where there's a lot of concern. Are people going to get left behind? We did a lot of work looking at that. So we're quite excited that there has been money put in place for something like that. To the digital piece of it and kind of having more of this infrastructure, I think we are seeing a little bit more the desire to have resilience created in business models. And that resilience creation should mean stronger capital investment through this cycle. Again, another thing we feel quite good about as we think about from a longer term perspective. I want to let others jump in, but I'm very passionate about this topic because I think it really matters a lot for the economy.
So I'd love to pull Prakash into this because I think GIC's got an interesting perspective here. We all often find there's a real tension between shareholders and other stakeholders in a business when it comes to capital allocation decisions. And what we're talking about here, bringing supply chains in-house, that's costly up front in the near term, but it can also sometimes benefit local communities and the company in the longer term, in the sense that there's some jobs associated with that investment in infrastructure and sets the company up for better resilience over time. From the seat where you're sitting, what effect do you really expect those longer term bets companies are making on things like R&D and CapEx and supply chain investment to have on local economies? Do you see them sort of on a similar time horizon to the financial return, or are there kind of pockets of divergence happening in the markets that you watch around the world?
Thanks, Harry. I think it's a very important issue, and I mean, you've raised it in the context of corporations kind of reshoring kind of supply lines back. And I think increasingly that need to, in a way, give back and reinvest in the communities that you're part of, I think has just increased importance. I think it's also becoming more and more relevant for investors like us, even though we have a global footprint. And I think you nailed it right when you said that, at the heart of it, the question is really about whether there's a trade-off between kind of doing well and doing good. And I think the philosophy that we've had is that, once you look over a long-term horizon, I think that trade-off really gets very blurry. And I think you can do well by doing good. I'll give you an example, actually, that we think of, and in a way, picking off what Jua said about infrastructure. And this is about kind of supporting the sustainability transition in emerging markets. As you know, I mean, the infrastructure requirements for that sustainability transition, it's huge. I mean, the IEA has numbers like 5 trillion a year, which is, like 5% of global GDP. It's a huge number. But I think also some of the EM governments have really become increasingly aware of that impact of climate change. And so how we have been trying to help support that journey is really being invested in that transition effort. And we have efforts to do renewable power plants in India, actually even in the US, helping coal companies make that transition. And I think that when you really kind of have that long run enough perspective, that alignment between shareholders and stakeholders actually gets very strong. And I think there's increasingly scope for activities that will really generate very good returns. But in fact, in the infrastructure space, I mean, if you do believe that we're kind of moving to a little bit more high inflation environment, actually more resilient returns. But at the same time, also kind of positive social, economic, environmental outcomes in these communities. So I think that trade-off maybe may not be as big a deal as maybe we think it is.
So I want to just stick with you for a minute there, because you mentioned the potential for inflationary pressure as a result of that transformation, and we've had a question in the chat here that I'm going to incorporate. So the question that's been posed is really, can we think about the investments required for the capital transformation, asset reallocation, and is that likely to have inflationary or deflationary pressure as we shift, as we shift kind of from the renewables are cheaper than fossil fuels or negative positive pressure on GDP, fiscal stimulus versus carbon taxes. There's a lot of focus on the inflationary environment on a go-forward basis. Are you seeing some of this transformation contributing to that environment, and how will that impact longer-term investment behavior?
Yeah, I mean, I think whatever probability you placed on a high inflation scenario before COVID, I think that probability has definitely increased from where we sit today. And the kind of more secular push with regards to the investment spend needed, I think it's just part of it. You still have a lot of easy policy settings, I think, globally. But I think importantly is that balance sheets are a lot healthier, I think, coming out of this period than you had after the financial crisis. I mean, so there were, this in those kinds of bursting of bubbles, you had very long periods of deleveraging. Whereas you don't have that now. We talked about new business formations, but I mean, if you look at the household net worth balance sheets in the US, it's phenomenal. I mean, it's spiked up very sharply. Now, there's a lot of inequality within that balance sheet, but still, you can't argue that the kind of broad-based deleveraging pressures. So we are really at a point where everyone who has the capacity to spend, I think, can spend. And I think that the infrastructure push, and I mentioned that $5 trillion number. I mean, we see it. When we go around and look at a lot of the deals that are coming by us, the transformation that you're seeing in the energy space is just phenomenal. I mean, I think the way that we produce and consume electricity is just really going to change within the next decade. And I think in the near term, that is going to be very inflationary, so that even as fiscal steps back, you're going to get private demand, I think, coming back to fill in that gap. Now, I think in the long run, I think that hopefully we build up enough capacity, and I think also going back to what Julia was saying, that you are in a way adding capacity to the economy. But I think at least over the next 2 years, I mean, we ourselves are particularly concerned that likelihood of really kind of going into a high inflation regime is quite meaningful.
Ariel, may I
Yeah,
add
please.
a little something? Prakash put everything so well, but I want to in particular just highlight why some of this is occurring. Because of everything Prakash mentioned about the aftermath of the global financial crises, which was a period of deleveraging, there was underinvestment in a lot of areas, right? People were just not investing, especially in physical parts of the area, of the goods related economy. And so what has happened is that when we think about this transformation to a green economy, many of the resources needed are areas which have been underinvested in. So what powers wind and solar and so on is not just wind and solar, but sometimes the components required may require some metals or minerals or certain things where we have not invested for a long period of time. And that is putting upward pressure on a lot of real assets where that chronic underinvestment, because of the bust that took place in GFC, is sort of now translating into higher prices, even as we try to move away, if you will, from fossil fuels and so on and forth. So that's sort of the risk that even though the desire is to move away from some of these areas, we're putting undue pressure on them in the near term as we make that transition.
Yeah, maybe I can follow.
Please.
I think that's a really important point of just where we see the asset price inflation on those, those materials related to development in the green sphere and development in technology. And as that demand grows, you create a lot of asset price inflation on the back of it. What's interesting is if you take that piece, and then you think about how that investment in technology is affecting the labor share of income versus a capital share of income. Capital share of income, growing very quickly and continuing to erode that labor share of income. And then you get not just, as Prakash mentioned, the disparity of income as a result, but you also get a disparity of spending from consumers. And so that's going to have a knock-on effect. So as we start to think about the ultimate inflation effects, you have those core materials that I think Juhi highlighted, the overall dynamic coming out of the pandemic, which has been that disruption in the supply chain. And as that starts to evolve, you're going to see that those pockets become clearer on just where those prices remain elevated. But in the same token, on the tail end of it, you're going to have those wages growing for the proportion of the population that benefit from that technology or that productivity when Juhi was being wonky earlier. And as that productivity gain grows and you see those higher wages for those folks, there's a whole heck of a lot of folks that lose out on that. There was an OECD paper that highlighted, I don't remember the numbers, something around 30% or so of the global labor force that would be at risk when you end up with these significant developments in productivity or digital evolution. As we move to robots, somebody loses out, people who used to be the robots. So that transformation still has to happen, and that's going to create that disparity of income, and again that disparity of spending, which is going to have that ultimate effect, which is going to dislocate the way we think about inflation, I think, and rebalance it in a way that we haven't fully appreciated.
So maybe since we're on the topic, I'll stick with this kind of labor human capital theme. We had a question submitted earlier on that was really focused around the fact that investments in intangible assets and things like human capital are really difficult to track, kind of using traditional financial statements. But the pandemic highlighted the importance of those investments to corporate success. And Prakash, you and I were speaking a little bit before we went live, that labor shortage has never really been a problem before, but now it's really front and center. And at the same time, we're talking with Brooklyn about the fact that a whole swath of folks may be out of work as a result of some of these trends that we're looking at. So how do you really see labor and human capital and talent kind of shaping that impact on corporate and consumer behavior? How would you, this is a question to everyone, not just Prakash. So how would you measure kind of returns on things you can't see? And how do we think about human capital as an important limiting factor for economic growth on a go-forward basis?
Yeah, no, I think that's it's a very important question. So when I think about the labor input, there's what I call an extensive margin, and then there's an intensive margin. So the extensive margin basically is just the number of people, and then the intensive margin is just how well you use that pool of people. And I think as we've realized, and it's not just a developed economy phenomenon, it's actually also true for the case of China, that extensive margin is shrinking, right? So the growth of the working age population has actually slowed down quite significantly. China, we're looking at only 0.2%. Even in the US, it's fallen below 1%. So in that sense, that shrinking pool of labor, or rather a slower growing pool of labor, I think is just going to bring trend growth down. The challenge is really whether with the existing pool of labor, you can do more with it. And actually going back to the case of China, that's been one of the success stories that's not been advertised as much, which is this whole process of urbanization, right? Where you're taking a worker who is relatively less productive in the agricultural sector and bringing them into a manufacturing sector job, etc. So even as that extensive margin shrinks, you still actually get more from that pool of labor. I think the challenge you're facing now, and it's an interesting contrast, is that you had the US and pretty much all of continental Europe and the UK kind of approaching the COVID situation very differently. So the US approached it to say, look, I'm going to sever that link between the worker and the job, but I'm going to provide, checks in the mail, like very, very strong income support, so that you can see yourself through the transition. Whereas in the UK and continental Europe, it was much more a furlough scheme system, right, where you preserve that link between the person and the job, but then you kind of moved down into like some kind of a subsidized wage type scheme. And I think the challenge we're seeing now is that once that link between the worker and the job gets severed, people just make very, very different life decisions. In the US, there's no labor force participation really hasn't come back up in a meaningful way. And a large part of that is because people have taken early retirement, but also, the issues around COVID, needing to care for people and all that. So if that group of people who have taken early retirement do not come back, then you really need to improve that intensive portion, right? You really need to make sure that human capital is high, and ultimately, at least for the people who have not come back, it's going to require kind of higher wages in a way to really try and entice them back. But I think this whole episode has really been an interesting kind of natural experiment, if you will, on really whether cutting that link between the worker and the job really facilitates easier reallocation, which is the philosophy behind it, or actually it makes people just kind of step back from the labor market.
So, Brooklyn, I mean, you're sitting at an organization that's really focused on consumer behavior in an effort to build a more inclusive economy. How do we refocus investors on the long term in a way that would drive more equitable, sustainable growth over time? I think you pointed out the gaps that we were seeing being magnified. Any thoughts there around what might fix that?
I don't know how to fix that, but I will say this will be a classic redirect. But I think that what some of the elements that Prakash was talking about is it's not just that severing of the cord between people and their workforce. It's a question also about the physical location. I just want to draw back in the question earlier, which is on fixed assets. And what we've learned is that, no matter how much you dangle exciting get-togethers, people just don't like coming back to the office. Or at least now they don't. Maybe that changes long term, who the heck knows. But for now, people don't want to come back. And that has created this dislocation of labor that we see in that labor force participation in many countries, that it's influenced by not just that unwillingness, but also, some of the stimulus stuff that went out as well, or still lingers, those excess savings that have allowed them to make that decision. But that rebalancing of power between the employee and the employer is quite significant. And location, the suburbanization of workers is significant, and creating these kind of pods of workforce in more suburban areas, as opposed to the big location that you draw everybody into from all over, the big office. So those satellite offices, the kind of satellite demand that gets created, and what that means for all levels of both production and logistics is significant. If we're all, living in, further outside of city centers, and we see that, massively as a result of the pandemic. It's a small businesses and more suburban areas and rural areas that massively outperformed the large businesses and small businesses in central business districts or places like that. So that as that demand expands and kind of grows these smaller towns and areas in ways that they hadn't been grown before, you're now creating additional challenges. There was a reason why, some of the, for example, grocery delivery wasn't as popular in more suburban or rural areas, because it's just really far to get to these places. The houses are not very close together, and it's just really expensive to deliver that stuff. And so now, because that growing demand and the expectation is happening at the same time, it's creating that dispersion of labor and capital as a result. So that, I think, is an important element of this. And the flexibility of that arrangement with these workers is, of course, I would say, an evolution. I don't know where we are in that evolution. I don't think we're at the end state right now. I think we've kind of swung really hard one direction. I think we'll swing back. But I'm also sitting in an office, so that may be a little biased.
But I think it is an interesting point here. We were talking about the pressures on supply chains, and with a more dispersed workforce, that's only going to increase the demand for those distributed services and potentially further pressure that supply chain that's already lacked investment, to Julie's point. I want to circle back to one thing that we were talking about a little bit earlier when we were, Prakash had mentioned easy monetary policy and the role of monetary and fiscal stimulus in all of this. And there was a real unprecedented amount of that coordination amongst central banks and governments around the world. Economic stimulus payments contributed to some cash building on household balance sheets that we saw in the Compass report. We also know that central bank bond buying means governments are amongst the biggest corporate creditors in many countries now. We're starting to see some pressure around interest rates and inflation. What implications will government intervention have as they start to unwind when we think about capital markets behaviors and investment horizons going forward? Maybe I'll start with Julie on that one.
I'll take a crack at it. Let me start by saying how humbling it has been to be in the investment management business over the last decade and a half. I have seen things that no textbook ever taught me, and I certainly would have laughed at some of those ideas had somebody said them to me, 20 years ago. I would say, what do you mean negative interest rates? What do you mean we're going to, do what? So I've learned a lot. So take these insights as with a grain of salt, because again, we get a lot wrong, and I want to be sure to acknowledge that these are really just thoughts along the way. So my first one would be that I believe that the persistence of fiscal policy is in many parts of the developed world is a feature that seems like it's lingering. That is something very distinct and different than the behavior post the global financial crisis. And I think it's very important because if you have persistent fiscal policy, then at some point monetary policy has to do less work. So yes, you're right, Ariel, we started with both sides doing as much work, but if fiscal policy lingers, we probably need a little less from the monetary side and a little quicker than we saw before. So that's number one. The reason this matters is because I think that there have been distortions in financial markets in many ways because we don't know how to price many instruments when there has been such intervention at such a large scale from price insensitive entities holding larger parts of the markets, and in this case being central banks, right? They had stated goals, they were going to be in the markets, and that made a lot of players price insensitive. And this goes back to something Prakash said earlier, which is we now have a lot of new players in the market who have not witnessed any other form of investing, and they just haven't. This has been the norm for a lot of years. So that's really why I preface my comments by saying very humbly, we are going to discover what it feels like when we try to unwind some of this. And I think that this price discovery can probably take place only gradually because systems are still levered. Yes, they've been delevered from before, but they're still pretty levered systems. But I think there are going to be areas where we are going to discover that the emperor didn't have clothes in some parts, i.e. we had areas of froth in the market, and we need to sort of be cognizant of where we think capital has been allocated responsibly and efficiently. And I think there are large swaths of that. So please don't get me wrong. I think there are largely this has been the case, but I do think we will find more about these pockets as some of this unwinds.
If I can jump in, I think there's one element. I may disagree a bit with where Juhi went there on a technicality, and she'll understand why in a minute. But the investment that we've seen from governments, it's a question of which government you're talking about, right? So if you're talking about a government that will go unnamed in this scenario, you can take wild guesses, I'm sure. But if you end up creating programs that are trying to make up for the fact that you don't have fiscal policy or counterbalances in the event of a crisis, and you're just trying to make up for the fact that you don't have that structure in place, that's a very different policy than above and beyond what those the real catch policies that prevent the social destruction or keep the workers attached to the businesses in ways through some economic cycles. And you can also argue that there are some cycles where one model is better than the other. But the question about persistence with fiscal policy really comes down to the design of the policy itself. And if we end up with a fiscal policy with bad design or without developing long-term solutions for that counterbalance, you could actually end up with something like we see today, which is monetary policy having to respond to fiscal policy. So a more active central bank having to take away some of the juice when a different fiscal policy could have resulted without that. So I think that construct really matters in terms of that balance between the two. And of course, bringing Prakash in this, not to throw him into the ring, but is that that matters a lot for that inflation story and just how much real inflation that's driving, whether it's asset price inflation that it's driving, because it matters, whether or not the central banks are needing to step in to control that, or whether it's more organic, long-term sustainable growth that's being generated.
Franklin, point really well taken. I couldn't agree more. So thank you for bringing it up.
Prakash, did you want to take the bait there?
No, I mean, it's every time these kind of events happen. I mean, so I started my career in late 90s during the Asian financial crisis. Right? It's been kind of one after the other. You always kind of question yourself whether things really will change. And so, I think this persistence of fiscal support, I worry, I mean, we could be one midterm election away from going back to gridlock, and suddenly that I mean, I think that there were elements of the pandemic which made policy stimulus very straightforward, and I think the biggest feature of that was that it was completely exogenous, right? So there was no kind of moral hazard issue that was prevalent, if you were to kind of just be throwing money out, and I fear that may change. But I have to say that where I think the Juhi is spot on, I think is when you just step back and look at a bit more of a global picture. I think the rhetoric and the discussion in Europe, I think that has really fundamentally shifted. I mean, rethinking fiscal rules, rethinking the role of countercyclical policy, issuing debt at the central level from the European Commission. I mean, these are things which I think are here to stay. So that there is I think a lot of the word paradigm shift is often used, but I think there is some truth to that in that mixture between monetary and fiscal. But once again, going back to that inflation story, if that really takes off, I think that world of doing stimulus with no cost, I think that goes away, and that trade-off starts changing, and then we will start to see policies going in the other direction again.
So I'm gonna take the wheel here and shift us slightly, because I think we'd probably be remiss in not talking about climate's role in everything we've seen in the markets lately too. So we've talked a lot about the pandemic and policy intervention to support markets in the face of that upheaval. But I think, we've also seen a real source of investment horizon pressure could be related to the proliferation of net zero and decarbonization commitments. So I'd love to do a quick lightning round. As decarbonization becomes more mainstream, is that the wedge issue that could be an opportunity to embed longer term investment horizons into asset allocation decisions? Is it forcing a rethink in terms of the way that we do business and the way that we allocate capital that could push us in that longer term direction more permanently? Or is that a Pollyanna view?
So lightning means one word answers, or?
Maybe 1 minute.
Well, I can go for it. Like, I think that the way you've described it, there's a lot of, let's call it opportunity to, with all the commitment to net zero, with all of the attention to climate change today, there's a real opportunity to shift a corporate landscape and focus on the climate agenda and what you do. There's also a responsibility, given the potential impact of a corporation, to really consider the physical footprint as well as the potential of the business. I think, from my experience, what I've learned, and like most people, continue to learn a lot about this all the time. So just keep that in mind. But it really is a significant challenge to think about the localization of a lot of these climate events. Because as we think about it from a national perspective, it's really hard to come up with a climate event that affects an entire country, unless it's a really small country, in the Caribbean or something like that. Then you could say, yes, big impact. But if you're talking about real big companies or real big countries, then you're starting to get in this sphere where, that climate impact ends up being, a small piece that ends up kind of, picking apart the long-term investment agenda of a corporation or of a country and where they see the growth prospects. So I think that element is challenging, but this is an opportunity right now where budgets have effectively been cut dramatically during the crisis. Now you're asking for increases in budget, and there's a lot of opportunity to play the two sides here and look at, well, how do we achieve, what Prakash was mentioning, the for good agenda that can really accomplish where you're trying to go. The costs have come so far down that it's just good business to go down that track today. Now, from the consumer perspective, now I'm starting to get into much longer than a minute. Sorry for that. But from the consumer perspective, I'm not convinced that they're on the same track right now, because they're just so price sensitive that if you're looking at two goods, whether it's a flight and you're looking at two flights next to each other, it seems like, it's still too soon to tell right now, but it seems like people are more price sensitive than they are carbon sensitive today. That dynamic has to come eventually.
Julie, maybe I'll turn to you next. Is climate the wedge issue that could push us in longer term directions from an investment perspective?
I'd like to believe so, Ariel. I really truly would. So Wellington is a founding member of the Net Zero Asset Manager commitment. And I can tell you that I've spent a large part of this year thinking about climate and how we should be approaching it from an economic perspective, from the capital market assumptions, and our engagement with our companies, which is how we can influence this, and where we spend a lot of our time in actively engaging corporations as we talk to them about their climate footprint. We are thinking a lot about physical concentration risks. We are thinking a lot about resiliency. We are thinking a lot about the plans for investing in that medium and long term, the sort of the question that you're asking. So this is really part and parcel of the due diligence that we're doing with companies every day now. And I think the global aspect of it really makes it sort of that mega shift that can make a difference.
And then Prakash, you're a meaningful asset owner, looking at this across various asset classes and different lenses on your portfolio. Any view on whether climate might be the wedge that drives longer term behavior?
No, I would give that answer a resounding yes. I think it is. You're seeing the stars line up across a variety of dimensions, and I think that the incentives are such that it's not only pressure from stakeholders, but I think it's also it just makes much better business sense in order to do these things. And I think you are getting to that point, as I mentioned earlier, that you can do well for your shareholders by doing good. If I can pick up on a point that Bricklin made, which is on the consumer side, where he mentioned that consumers may be too early to tell because they're very price sensitive. I think that's right, and I think that's precisely why ultimately we need to get to just a much more accurate price for carbon, because I think at the end of the day, if consumers respond to prices, then that's really the signal, and it's politically a really difficult decision to do, but doing good relative price changes with kind of broad-based subsidies. I mean, these things have worked in other countries, but I think that, at least on the consumer side, is where I think will tip the needle.
So I'm looking at the clock and I want to be sensitive to everybody's time. So I'll ask just one final question, and it really is a lightning response this time, please. What's one kind of major emerging theme you're paying attention to that you would expect to meaningfully influence corporate or investor time horizons on a go-forward basis? Kind of the one thing to watch, and how could investors best position themselves to take advantage of that opportunity? We'll start with Bricklin again.
I think that just speaks to this whole conversation, right? What is the one thing? It's that balance between short and long-term investing. It's that time frame of how businesses are looking at doing share buybacks or actually investing in the more sustainable platforms. And it goes for governments too. Are they building out the infrastructure? Are they just giving away money? And so I think it really is that time horizon, that if we had one magical indicator that gave us a bellwether, it would be that.
Julie?
I believe that the developed world, or large parts of it, are on a path towards higher nominal growth because of all the things that we've talked about. And I think that's a really important thing for us to consider. Given all the gloom and doom that's out there, the ramifications of that is really how we spend a lot of our time thinking about the future.
Final word, Prakash.
Well, I'll bring it back a little bit to the sustainability thing. I think that one theme that really excited about, I think, is this issue of energy transition, and I think it's starting with renewables, but I think it goes into electrification, it goes into hydrogen, and then ultimately even various forms of carbon capture. I think it's a multi-year story, and it's really, I think, quite revolutionary, and as a both as an investor but also as a consumer, I think really quite rewarding.
Well, thank you all so much for joining me today. Julie Dewan from Wellington, Prakash Kannan from GIC, and Bricklin Dwyer from MasterCard. It's been a fascinating, rambling discussion at points, but I think, central to all of this, we find that really these questions around how we really get to longer investment time horizons will be central to how economies emerge from this pandemic and how investors and companies respond in that new environment as we think about reshaping the fabric for a transitioning world. So thank you again for spending some time with us today. All of our research is on our website at FCLTglobal.org. And I owe a big thanks to my colleague, Demi McClure, who has facilitated the conversation. So thank you to Demi. If there were any questions we did not get to, please shoot us a line at research@fcltglobal.org, and you can reach me and my team. We'd be happy to chat further. So thanks once again to our wonderful panelists. It's really been a pleasure.
Thank you.
Thank you. Thanks, everyone.
Bye.